one of the most often asked questions over the past month, and actually with good reason, is about, again, interest rates. And specifically, why does the administration want to lower interest rates? And in our latest public quarterly podcast, which you can get on any one of the players, we actually tackled the question, but that question was, will the Federal Reserve cut rates? And the other question that we're getting is why. So before we jump into it, just a reminder that each month our goal is to help you understand four main things. And here they are. We want to help you understand what's happening right now. We want to help you understand why it's happening. And then here's how it's impacting people. And then here's what you can do about it. So I'll start today with the question, should you wait to take out a mortgage or borrow money? So in order to do that, and before Aaron jumps in here, I just want to first assess the current environment as it stands today in the beginning of August of 2025. And this is not a political statement. So I want everybody to either rewind and listen to that again, and then I'm going to say it again to make sure everybody understands that this commentary is not a political statement. So now that we've gotten out of the way that this is not a political statement, you have to forget the political narratives for the moment that are surrounding interest rates, the Federal Reserve, the war going on between the Fed chairman and the White House. All of that narrative is irrelevant. Let's just talk about the facts. And the facts are that in July of 2025, the employment report showed 73,000 net payrolls with two very large downward revisions. We had a downward revision of 125,000 jobs in May, and we had a downward revision of 133,000 jobs for June. Okay, so when you account for that, the private sector payroll growth is basically at stall speed. Okay, that's data, that's the facts. Forget the narrative, forget the name calling, forget all of it. Those are 3 months of facts. And when people want to argue about the revisions and the size of revisions, those revisions are exactly what they are. They are revisions. And companies have to report these numbers to the federal government. And look, if I was the president of the United States, which I can't be because there's pictures of me in my 20s when I was in the Marines and deployed overseas, so that's just never going to happen. But if I was the president, I'd just be like, look, guys, here's the deal. This is like a tax return. You need to get us this data within the next 30 days, or you get $1,000 a day fine, something like that. Okay, but that's not happening. That's why these revisions happen. Revisions are revisions. They are what they are. Now, this is the big reason why a lot of chatter is going on about Fed Chief Jerome Powell being behind, or as name callers like to say, too late on cutting rates. And that is the data behind the conversation that's happening about, is the Fed too late on cutting rates? So prior to the July jobs report, the Fed Fund futures curve, which is a predictive thing, forget the name, it just predicts where interest rates are going to be down the road, had basically given up on predicting much more than, say, about one rate cut, if that, by the end of the year. Now it's expecting 2.5 cuts. Don't ask me how you get a half a cut. Okay, but it's expecting a 2.5 cuts for the rest of the year. And then for 2026, it's expecting 5 more cuts, which, by the way, is back to where that predictive curve was predicting interest rate cuts during the April tariff panics. Okay, now I'm personally, Aaron, you're going to get a chance to debate with me if you want to, but I'm in that camp that 2 cuts are going to happen in 2025. I just think that's probably definitely in the cards now with this stall speed in the jobs report. And honestly, maybe 3, but definitely not just 1. So that's my camp. That's my opinion. And for those who are now worried about the R word, recession, right? My opinion is that we are more likely to see a very low growth rate for the second half of 2025 versus any sort of outright recession. But the jobs report and the associated revisions, along with the recent soft patch and some of the domestic final sales, I mean, it does increase the probability of recession, but I don't think it's increasing the probability of recession to a meaningful number. It increased it, but still not anywhere close to 50%, in my opinion. Okay, so with all that context set, what does this mean for you, the borrower, someone who wants to borrow money? First, my opinion on this issue has always been and will remain, look, if you need to borrow money now, just do it.